Good afternoon. Thank you for joining us. My name is Joe Terril, president of Terril and Company in St. Louis, Missouri. We're private wealth managers with approximately $725 million in assets under management. Today is May 30th, 2014. This is an update for our clients as well as other interested parties. We're going to be discussing the collapse in interest rates around the world, its implication for investment markets, as well as world economies, and we appreciate you joining us. Assisting me today is Brian Curtis with our filming, and Brian, if you're ready, let's move on to what's happened with interest rates in the last, actually, 30 days. The story of 2014 year to date is the complete collapse in interest rates around the world. If we go back to the beginning of 2014, most people believed that interest rates would be going higher. Certainly textbooks and economic activity would imply that we would see higher interest rates. In actuality, what's happened is the exact opposite. A 10-year government bond in the United States has fallen from 3% to a recent level of 2.45. Interest rates around the world have dramatically fallen. In most of Europe, interest rates are even lower than they are in the United States. This includes sometimes countries that otherwise a few years ago were questionable credits, such as Spain and Ireland. Italy's interest rates are not lower than the United States, but they're certainly under 3% on a 10-year Italian bond, which is unheard of. So the real question as we look around is what's causing this collapse in interest rates. Some people believe this must be an indicator that we're getting ready to see a worldwide recession, or that for some reason the economy around the world is getting ready to collapse. We do not believe that, and we are not in that camp. We are living in a very unique time, unique to the extent, as I refer to the interest rates, that interest rates around the world are almost as low as they've ever been in recorded history. But what we really believe is happening here is we are in an environment where there's more capital around the world looking for investments than available investments. Central bankers have been very accommodative with providing liquidity in the last 5 or 6 years. Economies around the world are what I would say just okay, and consequently you see more money chasing after less investments. A few years ago in the United States, we were running a $1.7 trillion budget deficit. This year, it might be as low as $400 billion. That's $1.3 trillion in potential investments in new U.S. Treasury bonds that is gone from the potential supply. Economies in Europe are weak enough that there's not demand for money in Europe to borrow money either at the corporate level or government level. Austerity programs have taken place all over the world within the levels of government. They're not borrowing near the amount of money that they once did. Corporations are flush with cash. They're not borrowing the money that they once did. There is some equity issuance and demand for equity capital, but not near what it had been in previous years. So what you're left with is a tremendous amount of money, interest, dividends, new principal being generated every day that has to be reinvested. And when you look around the world, there just isn't any place that has a demand for the kind of money that is out there right now looking for a home. So we do not believe that this is any indication of a weakening or a bad world economy. When we look at indicators like the price of copper, the Baltic Freight Index, loadings and unloadings out of the port of Long Beach, California, when we look for indicators of world economic activity, we don't see a material weakness. So that leaves us with the question, which is, how long can this go on? You're seeing record high prices in stocks, particularly in the United States, because of the same reason. There has been a tremendous amount of stock repurchased by the corporations. The number of shares of stock outstanding is lower today than it was 2 years ago, 3 years ago, 4 years ago. So this amount of money has to bid up the prices of existing stocks in order to be invested. So we really believe that this is going to continue on throughout 2014. It's as simple as saying there is money looking for a place to be invested, and it's got to go somewhere. And when I talk about money, I'm talking about new money being generated every day. We see in the Middle East 12 million barrels of oil being sold every day at $100 a barrel. That money has to go somewhere. We see life insurance premiums that are paid in Japan every payday period. Those life insurance premiums have to be reinvested. We see interest and dividend payments on existing stocks and or bonds that has to be reinvested. We see 401k plan contributions coming out of paychecks for most workers in the United States that has to be invested. We see contributions to pension plans in Europe, and some of these plans are sizable plans that has to be reinvested. You put this pool of money together, and the question is, where are you going to invest it? And I think the predominant answer is most likely the United States, and therefore we're not afraid that somehow what's going on is creating a bubble in stock prices, that it's wild speculation. No, do not believe that in the least. We think prices can go higher, maybe to the tune of 5%. So as it relates to equity prices, we remain fully invested in equities. We continue to think that until a logical alternative presents itself, interest rates are going to stay low. They may go even lower than where we are today. But this is not an indication of some type of world economic collapse. So with that said, Brian, let's move on perhaps to talking about economies around the world. Just a quick visit with regards to economies around the world. In general, they are improving. Europe is certainly headed in the right direction, and zero growth is an improvement over perhaps negative 1 to 2% contraction that they had been experiencing in previous years. In the South Pacific, dominated by China, growth is slowing, but it's slowing off a much bigger base. And we don't see any pending economic collapse in China that's getting ready to drag the rest of the, excuse me, drag down the rest of the world's economy. So the one threat that is obviously out there to the world economy is any type of armed conflict, whether it be Russia and the Ukraine, China and Vietnam, what's going on in the last few days in Libya. But there's no way to really predict that and make investments on it. Obviously anything like that would cause big problems with the world economies in a hurry. So we'll hope and pray for people's lives and the betterment of society in general, that some of those issues can be resolved without conflict, warfare, or certainly any type of shooting and killing. So subject to that nothing like that happens, we look for continued improvements around the world. We think the United States is well positioned as anybody. The weather, certainly in the first quarter, wreaked havoc. Yesterday we reported negative 1% growth in the United States in the first quarter. But we are also in the camp that believes that was definitely weather related, and we think by the end of the year we'll be on a run rate of 3.5% to 4% real GDP growth. So we'll monitor this obviously day by day, event by event. Watching this collapse in interest rates around the world is an incredible thing. To think that we're alive to see an event that's never happened before in recorded history is nothing short of something that is really fascinating. And it's our job here, which we're doing, to monitor and look for every single reason of why this is happening. We have our beliefs, as we've stated, but also to make sure there's no ramifications that could negatively affect our investment portfolios. Brian, I appreciate your help in doing our filming today. And as I mentioned, today's May 30th, 2014. My name's Joe Terril, president of Terril & Company in St. Louis, Missouri, private wealth managers. And we will be back, Brian, 45 days to do an update, or as needed if any events break here in early summer that we think we need to update our clientele on.
Okay, I'll put it in the schedule.
Thank you, and thanks again for joining us.